Hello traders, and welcome to this short video just going over the Great British Pound and what we can expect to see next week. Also traders, I want to mention what's happening with the pound, what is the fundamentals driving its recent decline, and how this week's economic data and upcoming data will be key to the next direction for the pound moving forward. So traders, just reiterating what we saw recently, we saw heavy selling for the pound after the markets didn't anticipate a rate hike from the Bank of England after economic data out of the UK was surprisingly negative, especially with inflation dropping down to 2.5% from 2.7%, which really knocked the sentiment out of the pound for its previous uptrend, which was being bought because markets were pricing a 0.2% rate hike from the Bank of England in May. And if I can give you an understanding, traders, of why this was happening, what we saw with the UK economy after the Brexit referendum, then we'll have a thorough understanding of what we can see with the UK economy and how we should be trading the pound moving forward. So taking you back to 2016, we know we had the referendum where the UK decided to leave the EU and the pound plummeted by 20%. Now we know this was not because the UK economy started to perform badly overnight. It was more to do with the market's expectation on how would the UK trade with the EU, which is the UK's main trading partner, and this caused the market's uncertainty to make the pound be dumped by 20%. And this really affected the UK economy for the simple fact that import prices in the UK started to skyrocket because the pound was now 20% less valuable. So UK businesses importing goods and services into the UK to then sell within the UK economy suddenly found themselves with a pound which was 20% less valuable. And this caused businesses to try to keep their profit margins by raising prices in the UK. And this caused rapid inflation in the United Kingdom. And if I take you to tradingeconomics.com, which is a very good website I recommend you use, I'll show you the economic data which surprisingly became very negative in the UK and forced the Bank of England to begin hiking interest rates. So if I take you back from 2016, I can show you the impact of Brexit on the UK economy and how this really had a negative impact on inflation. So as you can see, traders, looking at inflation in the UK, so from 2016 it was near 0.5%, rapidly rose to 3%, and of course the central bank has a mandate to maintain inflation at a certain target, and it was way above the central bank's 2% target. So in November of last year was when the Bank of England hiked interest rates for the first time in 10 years to try to maintain inflation, to get it back down to 2%. And we must remember, traders, when a central bank hikes interest rates, they're going to lower inflation by causing people's mortgage prices, credit card loans, student debts, and all outstanding debt payments to increase in the economy to reduce people's spending capacity, and of course meaning the demand for goods and services goes down, and therefore people cannot spend as much money, and inflation will then drop because businesses will have to cut prices to try to attract back buyers to start spending within the economy. And this is how central banks control inflation. And we know then, traders, that high interest rates give a currency value because investors will park their money in any economy where we have high interest rates to get high interest payments on their investments. And of course, to invest in an economy, you have to first purchase the currency of the country you're investing in, because all investments will be sold in that country's currencies. And then we know that foreign money must be exchanged, giving this currency a high demand. And this is why, traders, whenever there's interest rate expectations, currencies rise in value, because that currency is then in a high demand from all the money coming into that economy for investments. So traders, we know we had high inflation. The UK in March this year was saying to the market that they're going to have to hike interest rates to a greater extent and at a faster pace, which basically meant to the markets that when they said a faster pace, the markets were originally anticipating a rate hike in August from the Bank of England, and when they said a faster pace, they took it forward to May. And this is why the pound started to rapidly rise across the markets. If you look at the pound across all the currency pairs, the pound was really appreciating in value because markets were pricing in the expectation of a rate hike. And then the Bank of England said to a greater extent. So the markets anticipated there may be a rate hike in May and then a rate hike in August. And this was really bouncing the pound up, value up across the markets, and really why we saw some really strong trends in the pound. However, then we had really weak economic data. We had inflation dropping to 2.5%. We had wages, more importantly, not rising. Now, if I've explained in multiple video traders about wages, and I've sent out information over and over again, but I will go over it. When unemployment in the United Kingdom is so low at 4.4%, This basically means that wages start to rapidly rise because there's only a small majority of people left in an economy to work. So businesses compete with each other for the remaining amount of workers by competing for higher wages. And when people's wages increase, people can spend more, and we know spending drives inflation. So this is why the central bank was closely monitoring wages as the key indicator to know when to start hiking interest rates again in the UK. But then we had wages come out softer than expected, which basically didn't mean that inflation would rise as rapidly down the line. And we know unemployment remained where it was. Retail sales spending came out very negative, so meaning that high inflation was affecting people's spending capacity. GDP growth came out at 0.1% for the first 3 months of the year, so the economy was growing really slow. And all this economic data really just pointed to the Bank of England not having an arsenal to hike interest rates, and this is what caused the pound to get aggressively sold off. And we saw a rapid decline in the pound's value after the string of economic data didn't really support the Bank of England to continue hiking interest rates. So where do we stand at the moment, traders? The Bank of England has said incoming data will be the key for the pound moving forward. And this week we have some really important data for the pound. We have CPI inflation, which of course is the most important indicator because CPI inflation is all to do with why the central bank will hike interest rates or not. So we know inflation is now at 2.5%. It dropped off from 2.7% in the last reading. Okay, now what will happen with the pound is if inflation goes back up, for example, to 2.7%, then this changes the picture for the pound. This puts more pressure on the Bank of England to hike interest rates because they're trying to get inflation back down to 2%. And while it dropped from 2.7% to 2.5% in the last reading, this gave them more room to wait and see if inflation continues to drop by itself. However, if it goes back up, then there's more chance of another rate hike, so the pound will then start to rise back in value, and this is an opportunity for us to buy the pound. Or if inflation drops even further, then there's of course it's an opportunity for us to sell the pound because that puts less pressure again on the Bank of England to hike interest rates, and all this previous buying in the pound will start to get sold off across the markets, not just against the US dollar, also against other currencies such as the yen, where all this buying has been caused by markets pricing in expectations of a rate hike in the United Kingdom. So CPI inflation is so important. We know that's the main indicator, that's the main driver. And then after CPI inflation data, moving forward will be average earnings, which is wages. So are wages in the UK going higher? Because if they are, remember traders, as people's spending capacity increases because businesses are hiring new workers, unemployment is so low, so businesses are offering higher wages. Also, businesses are recruiting at a faster pace to meet the now increased demand in spending because now so many people in the UK are in work. We must remember traders, businesses also start to raise their prices on the shop floor to offset the cost of paying higher wages. And this itself starts to cause rapid inflation because prices are rising from spending, from higher wages, and businesses covering their costs. And remember, the Bank of England is already trying to get inflation back down to 2% because it's above 2% from the Brexit referendum vote when it caused the pound to devalue and import prices to skyrocket. So with that being said, we know we need to closely monitor wages because that's the key indicator. This is also what the Federal Reserve is monitoring as their indicator to know when to hike interest rates. So that is the key. It is really down to wages and inflation, and that is driven by unemployment and how many jobs are brought into the UK economy, which is why employment is always the bedrock of any economy when trying to understand what a central bank is likely to do. So traders, looking at the economic data this week, we're going to closely monitor the inflation data in the UK, and that will give us a thorough understanding of where does the pound move from here. If inflation goes higher, back to 2.7% or 2.6%, the pound will start to climb again. If it stays where it is, the pound will probably remain where it is. If inflation starts to drop even lower back to 2%, the pound will weaken because there'll be no expectation of a rate hike. Any questions, traders, ping me a message. I will now send the text feed again, which I did post in the analyst channel, explaining how wages affects inflation and interest rates. And if you have any questions, please ping me a message. Thank you.